Today, let's talk about something exciting, your retirement. Not the kind where you're scraping by, but the kind where you're traveling, pursuing passions, and spending quality time with your loved ones. What if I told you there's a retirement strategy that can offer you steady retirement income while also providing you a safety net for your loved ones? Today, we're diving deep into the topic of an insured retirement plan, a powerful financial tool that's changing how Canadians approach retirement planning. Stick around because I'll show you exactly how the strategy can maximize your retirement income while keeping it tax efficient. I'm Gregory Rozdeba, the CEO of Dundas Life. After helping hundreds of Canadians secure their financial future over the past decade, I'm excited to break down this retirement strategy that many financial advisors aren't talking about. So let's dive in. What is an insured retirement plan, or an IRP? Simply put, it's a financial strategy that combines life insurance with retirement savings. Unlike traditional retirement accounts, IRPs provide dual benefits. They offer protection through life insurance while building a nest egg for your golden years. With an IRP, you leverage the cash value of your life insurance policy. This allows you to accumulate wealth over time while also providing a guaranteed income stream in retirement. So how does an IRP work? There are three phases to an IRP: the savings phase, the withdrawal phase, and the repayment phase. During the savings phase, you purchase a life insurance policy with an investment component. This policy will grow in value over time, and you can use the cash value to supplement your retirement income. Plus, the cash value accumulates on a tax-deferred basis, meaning you won't owe taxes on the growth until you access it. During your working years, you'll be overfunding a whole life insurance policy. This means paying more than just the basic insurance cost. This extra money builds substantial cash value that becomes your future financial asset. Once you reach retirement, you can start accessing that cash value. However, instead of withdrawing funds directly, you can take out an annual loan against your policy. Why? Because this loan is generally tax-free, allowing you to supplement your retirement income without triggering tax obligations. Finally, we have the repayment phase. When you pass away, the death benefit from your policy is used to repay the loan. The good news? Your beneficiaries receive the remaining amount completely tax-free. This means that not only did you secure your financial future, but you also left behind a legacy for your loved ones. If you're finding value in this content so far, make sure to hit that subscribe button to learn more about innovative financial strategies, like this one. Now, you might be wondering, is an IRP right for me? Generally, the strategy is best suited for 1. Business owners and high-income earners who want to maximize their retirement savings while minimizing tax burdens. If you own a business and have retained earnings, an IRP can be an especially smart strategy. You can keep your money in the corporation, where it's taxed at just 11 or 12%, compared to the 30 to 50% personal tax rate you'd face withdrawing it for an R. This means more of your money stays invested and growing for the future. Individuals who need both life insurance coverage and retirement savings. That's number 2. If you're in a high tax bracket, this provides a way to defer taxes and grow your wealth. However, if you're an employee and have sufficient retirement savings in your RRSP, this might not be the best fit for you. IRPs are specifically designed for high net worth individuals and business owners who keep significant savings in their corporation to maximize wealth and provide tax-efficient retirement income. So what are the benefits of an IRP? One of the main benefits is that it combines the security of life insurance with the growth potential of retirement savings, offering peace of mind and financial stability. An IRP also offers tax-deferred growth, which means that your savings can grow faster over time. You won't have to pay taxes on the gains until you withdraw them, and when you withdraw the cash value. You can do so in a tax-efficient manner, using the policy's tax-free withdrawals or loans. Because the cash value of your policy is not subject to income tax, you can use it to supplement your retirement income without worrying about tax implications. Finally, an IRP allows for tax-free wealth transfer, enabling you to leave a significant legacy such as $500,000 to your beneficiaries without paying estate taxes. So, how can you use an IRP to generate retirement income? There are several options available, including taking annual loans from the policy, using the cash value to purchase an annuity, or simply withdrawing the cash value as needed. The key is to create a sustainable income stream that will last throughout your retirement. and an IRP can be a valuable tool in achieving this goal. Let's talk numbers. To make the strategy truly effective, you should be prepared to commit between $20,000 and $100,000 annually for at least 10 years. This level of funding not only makes the strategy worthwhile, but also opens up better lending options and more favorable terms with banks. Here's an example of how an IRP can work in practice. Meet Sarah, a 45-year-old business owner who wants to save for retirement. Sarah purchases a life insurance policy with an investment component, and over the next 10 years, she contributes $30,000 per year to the policy for a total investment of $300,000. Now, here's where it gets interesting. From age 65 to 90, she's able to access $40,000 in tax advantage income annually. That's a total of $1 million in retirement income, plus she leaves behind $500,000 tax-free legacy for her family. Now I know what you're thinking. What are the potential drawbacks of IRPs? One of the biggest drawbacks is that the cash value of your policy is not easily accessible. If you need to access your savings for an emergency, you may be subject to penalties or fees. Additionally, surrendering your policy can result in charges, which can eat into your savings. Qualifying for life insurance is also necessary. This is something to keep in mind, especially as you age, or if you have pre-existing conditions, you still may be able to get options. Finally, the premiums for whole life insurance can be higher than term insurance. Minimum annual contributions, for example $10,000 per year, are required for effectiveness, emphasizing the importance of early start benefits. If you're just looking for basic insurance coverage without a retirement income component, check out our video on term life insurance. As you consider whether an IRP is right for you, think about the long-term financial goals. For example, if you're planning to retire in the next 5 years or 10 years, now is the time to evaluate your options. An IRP can be a strategic way to enhance your retirement income, but it requires careful planning. You should also consider the amount you'll need to contribute to make the strategy effective. For many, a minimum annual deposit of around $20,000 is suggested to make the most out of an IRP. This may seem like a lot, but remember, you're investing in both your future and the security of your loved ones. The earlier you start, the better your benefits will be. Also, keep in mind that this isn't just about you. An IRP can be a part of your broader family financial strategy. If you're a business owner, for instance, think about how this can benefit not just your retirement, but also your family's financial stability. A Dundas Life advisor can help you determine how an IRP fits in your financial plan. Now let's look at some advanced applications of IRPs. First, there's corporate implementation. When you're a business owner, you can actually use corporate dollars to fund your premiums, which is incredibly tax efficient. This strategy becomes even more powerful when we leverage the capital dividend account, or CDA, creating tax advantages for both you and your shareholders. For business owners, there's also an important distinction in how you handle loans at different life stages. During your working years, you might use a CSV loan or immediate financing arrangement. When you retire, you'll transition to an IRP loan, where the bank handles the interest differently, adding it to your loan balance instead of requiring out-of-pocket payments. Think about it this way. You're not just building retirement income, you're also creating a robust succession plan for your business. Now let's connect the dots between an insured retirement plan and estate planning. This is where things get interesting. When structured properly, your IRP becomes a powerful wealth transfer tool. You're not just creating retirement income, you're building a legacy that can span generations. The beauty of the strategy is that it allows you to transfer wealth to your family in the most tax-efficient way possible. Your beneficiaries receive the death benefit completely tax-free, and if structured correctly, you can even create a cascading effect of wealth transfer that benefits multiple generations. If you're finding value in understanding these advanced strategies, make sure to hit the subscribe button below. We're constantly sharing insights like these that can transform your financial future. An insured retirement plan is a powerful tool that combines life insurance and retirement savings, offering significant benefits and potential income during retirement. However, it's essential to weigh these advantages against considerations like higher premiums and minimum contributions. One of the benefits of working with a Dundas Life advisor is that we can customize an IRP to meet your individual needs. Whether you're looking to supplement your retirement income, leave a legacy for your loved ones, or simply create a savings net, we can help you create the personalized IRP that meets your needs. If you're ready to take the next step and learn about insured retirement plans, please click in the link below in the comments section to book a time with us today. Don't forget to subscribe to our channel for more educational content about life insurance and financial planning. By subscribing, you'll get access to exclusive content and you'll be the first to know when we release videos. Remember, the earlier you start, the more time your investments have to grow, ensuring a brighter tomorrow. Thanks for watching. See you at the next one.